Welcome to today's video, choosing your investment account. This is part 4 of the 5-part video series that I am doing, how female coaches or business professionals invest $3,000 per month to create a $1 million portfolio within the next 14 years. I am Tiffany Thomas, your wealth mentor. I achieved financial freedom in my 30s and became a millionaire at 40. I'm here to help you do that even earlier and easier and without bias. I do not work for any third parties or any financial institutions or investment firms. So everything I am sharing is just from personal experience, and I am not going to recommend anything that would not be in your best interest. All right, let's dive right in. Today I am covering 8 different investment accounts that you can invest in. And some of these are if you are a business owner or if you are not a business owner, or it could be either way if you do or don't own a business. So we are going to talk about a taxable brokerage account, a Roth IRA, a traditional IRA, and we're going to talk about business-specific accounts, which is going to include a solo 401k, a Roth solo 401k, a SEP IRA, a simple IRA, and then just a traditional 401k if you have an employer. I'm going to cover some criteria for each of these accounts and then the information regarding the accounts. That way you can choose which one is going to be best for you. And I actually go into detail about this in my program that I offer. So some of this information I'm sharing today is from my actual program. And I'm also going to share which accounts some of my clients have set up. Let's dive right into a taxable brokerage account. And I like to call my investment accounts buckets to help create a visual. So we're going to call this the taxable brokerage account bucket. And with this one, you can invest as much money as you want to. Also, you can withdraw your money whenever you want to. Of course, you will pay taxes on the gains that you are withdrawing, but if you keep them for at least 1 year, then you could actually be paying 0% in federal taxes, depending on how much money you're pulling out and what those gains are. And then also, you never have to withdraw your money. And there are no income requirements or limits. So you can be a really high earner and still contribute to a taxable brokerage account. Another great thing is that you can actually borrow against your own investments inside of your taxable brokerage account at a low interest rate, depending on your broker. It's called a margin loan. And then also, you have unlimited investing options within a taxable brokerage account. These are just a few benefits, but if you want more details about a taxable brokerage account, I go into more detail in this video here. I will leave a link above. Now let's move to a Roth IRA and a traditional IRA. And anyone can set up these accounts, whether or not you have a business. And these are an individual retirement accounts. So that's what IRA stands for. So you just set up your own accounts through a broker like Vanguard. And then you would need to invest money that you would be taxed on for that year. So it needs to be taxable income. And then you can invest up to $6,500 per year in 2023 if you're under age 50. But if you're over age 50, you can invest up to $7,500. And then also you can withdraw your earnings at age 59 and a half without a penalty. And I want to talk about some differences between these two accounts. So with a Roth IRA, your money is growing tax-free. Both the earnings on the account and any money you withdraw after age 59 and a half are tax-free. And then you never have to pull money out of the account. So you could leave it to your heirs. There is a 10% penalty for withdrawing earnings early. So any money that you've actually earned, that interest that you've earned. But you can withdraw your contributions, any money you've actually put in, tax-free and penalty-free at any time. That is one really cool thing about the Roth IRA. And there are income limits to be able to invest in the Roth. So if you are single, your modified adjusted gross income needs to be under $153,000. But contributions are reduced starting at $138,000. So you wouldn't be able to contribute the maximum of $6,500 if you're making $138,000 or greater. And then if you're married, then your modified adjusted gross income must be less than 228,000, with the reductions beginning at $218,000. And then with a traditional IRA, this is when you're able to reduce your current taxable income. So you would pay taxes later on when you are pulling the money out. And you must start withdrawing by age 70 and a half. So you cannot just leave your money in here forever. And then there's a 10% penalty tax for withdrawing money early before age 59 and a half. And there are no income limits to a traditional IRA. You can roll over a Roth or roll over your traditional IRA to a Roth later on. And I do have another video about that, so I will leave a link above. And honestly, the majority of my clients do set up a taxable brokerage account just because of the flexibility. And then they usually have a Roth IRA because they want to grow their money tax-free. So when they pull it out, they don't have to worry about paying taxes. Okay, and then let's talk about a solo 401k or a solo Roth 401k. So you can set one of these up if you are not working for someone else and have access to a 401k already. Or even if you do, you could set one up, but you would have to only contribute the maximum amount to both of those plans. So this is basically for just business owners with no employees, and you need an employer identification number in order to set one of these plans up. And you actually cannot contribute to a solo 401k if you do have full-time employees, though you can use the plan to cover both you and your spouse. And the contribution limit for 2023 is $66,000. And you can add an additional $7,500 to that if you are 50 or older. And then as the employee, you can contribute up to $22,500 or 100% of your compensation, whichever amount is less. And then as the employer, you can make an additional profit sharing contribution of up to 25% of your compensation. So you get to contribute as the employee and then contribute as the employer. The limit on compensation that can be used to factor your contribution is at a maximum $330,000 in 2023. But overall, the contribution limit is $66,000. And since this is a retirement plan, you can start withdrawing with no penalty at age 59 and a half, and then you must withdraw at age 72. And like I said, you can set up either a solo 401k or a solo Roth 401k. And if you're just doing the traditional solo 401k, that means that you are putting money in without paying taxes. And then when you take the money out, you will pay taxes on that. And then if you do a Roth, then you are going to pay taxes up front on that money that you are contributing. And then when you withdraw that money, you withdraw it tax-free. And one of my clients set up the Roth solo 401k so she could invest more money and then not have to worry about taxes later on. A SEP IRA stands for Simplified Employee Pension Plan. This is definitely best for those that just have themselves in their business or a very few amount of employees. You are going to make contributions from your company, not from you directly. This can be combined with a Roth IRA or a traditional IRA. And if you have employees whom the IRS considers eligible participants in your plan, you must contribute on their behalf. It is mandatory. And those contributions must be an equal percentage of compensation to your own. So whatever you are contributing to your own SEP IRA, you need to contribute to your employees' SEP IRA. And they can be considered ineligible if they have not worked for you for 3 years out of the prior 5 years. And this actually includes yourself. If you have a brand new business and you are under 3 years of running your business, you're not able to set up a SEP IRA. So you would have to wait for at least 3 years. And then another thing that makes them ineligible is if they are under the age 21, or if they've made less than $750 for the year 2023. Otherwise, all other employees would need to receive the same contribution that you are giving to yourself. And then contribution limits are dependent on your net earnings for your business. If you had a net loss, you cannot make any contributions for yourself, but you can still make contributions for your employees if you chose to. The maximum contribution for 2023 is $66,000, and it cannot exceed the lesser of either 25% of compensation, this is also the limit for each employee, or $66,000. And the amount of compensation you can use to calculate the 25% limit is limited to $330,000 in 2023. So you can't go over that amount. And then I just want to share a quick example. If you made $240,000 in 2023, you would take $240,000 and multiply that by 0.25, that 25%, and you would get $60,000. And then $60,000 would be less than the $66,000. So you could only contribute $60,000 for that year. And then also with a SEP IRA, it does reduce your current taxable income. So it is similar to a traditional IRA that way. And if you are self-employed, your deduction is 25% of net self-employment income. So if you made the contribution, the maximum, the 25%, that would be your deduction you could take on your taxes. And then when you pull your money out of a SEP IRA, you pay taxes then. And there is no Roth version of a SEP IRA. And you do not have to commit to contribute every single year to your SEP IRA. If you wanted to contribute this year and then not next year, that's totally fine. And then there are no catch-up contributions for those over age 50. And then you also can start withdrawing at age 59 and a half without a penalty, and you must withdraw at age 73. And you as the employer do not have to help with the employees' plan contributions. You don't have to help them select what they invest in, nor do you have to give them a certain IRA provider. They set that up on their own. They can choose their own provider and their own investments. Okay, let's talk about a simple IRA for just a moment. This is for business owners with no more than 100 employees. So it can be yourself up to 100 employees. And SIMPLE stands for Savings Incentive Match Plan. So with this plan, the employer and the employee can make contributions, and the contribution limit for 2023 is $15,500. Or if you are 50 or older, then you can add an extra $3,500 to this plan. And the employer contribution limit is 3% of the employee's entire calendar year compensation, or a default of 2% of the employee's salary, whether the employee contributes or not. And employees are eligible if they earned a minimum of $5,000 in compensation in the last 2 years that they've been working for you, and if they expect to receive at least that much in the current year. And you can start withdrawing at age 59 and a half, and you must withdraw at age 72. And the nice thing with this plan is that a simple IRA can be combined with a Roth or a traditional IRA. You can contribute to your simple IRA and, let's say, a Roth IRA in the same year. And then employees have funds completely vest in the simple IRA at contribution. That just means that if employees are contributing money to the plan, and so is the employer, so are you. And if they leave, let's say 1 year after, then they have access to all of that money. They don't have to wait for a number of years to have access to the full amount. And then you are required by law to match any employee contributions. Let's move to the 401k or Roth 401k, which I did not mention in the beginning of the video, so you're getting a bonus account with the Roth 401k. These are company retirement plans that you can contribute to. So you need to be working for someone else and have them offer a 401k or a Roth 401k. Some similarities are that the employer has selected certain investment options for you. So usually you're not able to invest in every single option out there. you have to select just from the list your employer has selected. And then as of 2023, you can contribute up to $22,500 if you're under age 50, and then $27,000 if you are over age 50. And then a lot of employers will offer a company match. So if you invest up to a certain percentage, then they will match that certain percentage. So if that is the case, I would definitely get a company match. And then some differences are with the Roth 401k, you would put money in from your paycheck after you are taxed. And then it would grow tax-free, so when you're withdrawing it, you do not pay any taxes. And then when you are withdrawing contributions from your Roth 401k before age 59 and a half, you can actually do that at a discount, so you wouldn't end up paying the full penalty or paying the full amount of taxes. And I'm not going to go into detail in this video about that, but just be aware. And then a change has been made. So as of 2024, you do not have to withdraw your money by age 70 and a half. And then with a traditional 401k, you are putting money in from your paycheck before you are taxed, and then you'll pay taxes when you are withdrawing that money. And then you must start withdrawing at age 70 and a half. And there are a few other details about these two accounts that I'm not going to mention. So make sure and do your homework before you start withdrawing money or trying to borrow money against these two accounts. And a lot of my clients already have a 401k, even if they are not currently working for someone else. And so I actually help them roll over their 401ks to an IRA or a traditional IRA, and we look at their current 401k if they are working for someone else and decide which investments they should be invested in to help them reduce their fees and make higher returns. Now that you have the information on all of these different accounts, a quick way to figure out which one is going to be best for you is to just ask yourself a few questions. For example, do you want to have a tax break right now, or do you want to have one later on? Do you want to be able to pull out money before retirement age, or is that not a big deal to you? Also, how much money do you have to contribute? If you know the answers to these questions, then you can narrow down which account is going to work best for you, and of course, you can set up more than one account. Comment below and tell me which account you are going to set up. I am curious to know. And if you do want help setting up your accounts and investing in the stock market, I have a free masterclass where I go over how I can help you do that. I will leave a link below in the description. You can click on that and check out the free masterclass. And don't forget to check out the rest of the videos in the video series. And the last one, video number 5, is going to be choosing your actual investment and then automating your investing. And if you found this video helpful, make sure and hit that like button and the subscribe button. That will really help my channel out, and we can get this information out to more people. So thanks so much for watching. I'll see you in that video.